Hello everybody and welcome to our Module 13 session covering the managerial accounting and budgeting topic. This is part 1 of 2 of this Module 13, and in this part 1 we're going to cover some of the budgets from the sales budget to the production budget and to the materials budget, and then in part 2 we'll cover the remainder of the budgets. So what we have here is just an overview illustration of the budgets. Now this is just really intended to show the interconnection between the various budgets and to some extent the order of the budgets. So we're going to start off with the sales budget. This really drives everything. We'll see that in just a little bit. The sales budget helps us to determine the production budget. How many units do we need to produce? And then once we know how many units we need to produce, we know how many materials we need, labor, and overhead. And then down below that, we have the selling general administrative budget, which notice the sales budget feeds directly into that as well. And then at the very bottom, really most everything connects to the cash budget, because obviously if we have sales, at some point we're going to collect it and get cash out of it. If we have to buy materials, pay for labor, pay for overhead, at some point we had to pay cash for it. And then even the selling general administrative expenses we had to pay cash for. Notice also that we can prepare what are known as pro forma income statements. These are budgeted income statements. This is basically what the income statements will look like, the income statement and the balance sheet, what they will look like if all of our budgets go according to plan. Now the idea here is that if we were preparing this in like something like Excel or some sort of software, the goal is that we build it based on certain assumptions, we interconnect everything, we link everything, and then if a particular assumption changes, let's say the labor rate changed, everything else stayed the same, but the labor rate changed, we can make that one tweak and all the other statements would automatically update. That's the goal with this type of budget. By the way, this is known as the master budget. The master budget is just a collection of all of the different budgets we have in our operations. So the first budget we're going to be dealing with is the sales budget. And we saw that in the illustration. It's the first budget because you really can't do anything without that. You can't start any other budget without knowing how many units you're going to sell. That drives the sales revenue and the cash collection. That drives the production and all of the costs related to that. So you just can't do anything without the sales budget. What I will say here is that this sales budget, once you have the numbers, is the easiest budget to put forth because we just have two items that we're doing. We're multiplying two numbers. The expected number of units sold for that period and the expected sales price per unit. Now, I say once you have the numbers, so from a textbook perspective, this is the easiest budget. However, in reality, with a company, there's a lot of hard work that goes into getting the expected number of units sold, and sometimes even the sales price per unit. You might determine whether you need to have a sale that period to generate more sales, a discount if you will. So all of this information is based on a lot of historical data and various assumptions for the future, because keep in mind this is a prediction of what we think we're going to see in the future. So we have to take a look at market data, economic data, capacity information, and a variety of other indicators. Here's an example of the sales budget for a particular quarter, April, May, and June. Now notice, as we said, it's the number of units multiplied by the price per unit to give us the expected sales dollars for the unit. And then, of course, you can sum the quantity and the total dollars up to get a quarterly balance, but obviously the price per unit, we don't want to sum that up. It's not 51 plus 51 plus 51, it's just 51 by itself. Now, here is the important thing to note. When you're doing a sales budget and when you're doing the entire master budget, you also need to know the next 2 months of sales. We need to know July and August. And the reason for that, which we'll see in just a bit, is that we need July sales. We need the very next month's sales in order to help us calculate the production budget, desired ending inventory for June. So what we'll see when we get to the production budget is that part of our calculation is determining how much of next month's sales do we want to produce and have ready to go at the end of this month. So we need to know a desired ending inventory based on next month's sales. So we need to know July to be able to get June's ending inventory. So you may question, well, why do we need to know August? For August, when we get to the materials budget, you're going to see the same basic thing. Materials, we want to have a desired ending inventory as well, but it's based on the next month's production. So we need to know July's production to get June's ending inventory for materials. To know July's production, we need to know the next month after July, which is August's sales. So it goes 2 months out is what we're basically saying here. So now the sales. To identify the number of units and the price per unit, we need to know what the customers want, what they need, and what they'll pay for it. Are we positioned to provide that service or that product to them? How strong is the competition? Because that has a direct impact on price. In many cases, there's price pressure. And of course, what market share do we currently have? And are we willing to potentially lose some of that by keeping our prices steady? Those are all the things we need to consider when looking at the sales budget. Now, of course, if we plan to produce something, we need to know whether we have the capacity to do it. Regardless of the demand, regardless of what we want to do we have the capacity? Is it reasonable that we can even meet that expected sales amount? And if we are thinking of expanding, we need to know if the expected sales increases are long-term, or is it just a short-term demand fluctuation? Because if it's just short-term, we don't want to necessarily invest in long-term capacity, because then we'll have excess capacity in the future years. So we need to see if these expected sales increases are long-term, and if they are, and if we want to be in that market with a larger market share, maybe we would invest to increase that capacity. All of these things come into play. Now, for the production budget. So this comes directly after the sales budget or immediately after the sales budget, because now we need to know, now we know how many units we want to sell, and we have to get going on the production. What we're going to see here, again, it's not just the same number. If we expect to sell 100,000 units, we're not necessarily going to produce 100,000 units. First of all, we're probably going to produce a little bit more than 100,000 so that the first day or the first few days of the next period, we don't have to wait for production to complete. It's done. We have a little bit of inventory sitting there ready to go. It's a desired ending inventory. So that's one reason why we may produce more than sales, but the other part of that is, remember, if 1 month has a desired ending inventory, that carries over to the next month as beginning inventory, and that means if we thought we were going to sell 10,000 units and we wanted to have 1,000 extra units, we need somehow to get 11,000 units, but if we already had 3,000 units, then we only need to produce 8,000 units. Now, I know I'm going through that pretty quickly. We'll see an illustration of it in just a bit, but I just wanted to mention it a few times to get it to stick. So once we do the production budget, this is going to lead us to 3 other budgets: materials, labor, and overhead, that directly support production. Now, the other thing I want to mention here, I'm going down the path of a manufacturing firm. If we're talking materials, labor, and overhead, we're a manufacturing firm. We build products. But if we were just a merchandising firm that just buys and sells products, then we don't have these 3 budgets. We just have a purchases budget. So it's a little bit different. It's actually easier. So we need to know this company's policies on inventory maintenance. In other words, that desired ending inventory. How much do we want left at the end of this period to prepare for next period? We'll see the budget in the next slide, and I think it'll make a little more sense then. It tends to be a percentage of next period's expected sales, whatever management has set. So we need to produce this month's sales plus whatever the desired ending inventory is. But remember, we already have some of that inventory sitting there because last month's ending inventory carried over to be this month's beginning inventory. So here's an example of what might happen. For April, May, and June, we bring over the sales units, plus we have a desired ending inventory, which, as you can see down here, for this company, it's 20% of next period's sales units. So this 3,600 desired ending inventory for April is 20% of May's sales. 18,000 times 20% is 3,600. May's desired ending inventory is 20% of June's 21,000 units. Now again, for June, the desired ending inventory, we have to go forward to July and take 20% of July's 15,000 units. We're going to need July's desired ending inventory as well. Again, to carry forward, we're going to need this for the materials budget. So July's ending inventory is 20% of August's sales units. Notice we don't have to complete anything else for August. We just need that one number. Now we'll see the rest of July in just a bit. So we have a desired ending inventory for April, May, and June. And we can add those up and we'll get the total inventory requirements for each of those months. What we wanted to sell plus what we wanted to have in ending inventory. So for April, for example, it says somehow we need to get 12,100 units. But we don't necessarily need to produce 12,100 units because we already started the period with 1,700 units from last month. Now, by the way, we don't see March here. If we did see March, then March should have a desired ending inventory of 1,700, which carries forward to become April's beginning inventory of 1,700. But if you're ever working a problem like this, and they give you this desired ending inventory percentage, the other way to find a particular month's beginning inventory, if you can't see the prior month, is just to basically follow the same rule. What would we have done to calculate March's ending inventory? We would have taken 20% of April's sales. So if we wanted to calculate the beginning inventory for April, we'd just take 20% of April's sales, that same month. That's a way to calculate it without having to recreate March. So we do not need to produce the 1,700 because we already have it. That tells us we need to produce 10,400. And May and June, you can do the exact same thing. The other piece I want to talk about here is that when we are dealing with the quarter, if we're dealing with the total amount, for example, some of these items you can sum up. So like the sales, yes, you can sum those three up to get the quarterly amount. But the ending and beginning inventories, it's not a sum. For the quarter ending inventory, we need the very end of the quarter, which is also the very end of June. That is the end of the quarter. So June's ending inventory carries over to become the quarter's ending inventory. For beginning inventory, the beginning of this quarter was April. So we need April's beginning inventory, which is also the beginning of this quarter. So I just wanted to point that out as well. Next, we're going to move on and create the materials budget. The raw materials budget, what do we need to purchase to get ready for production? Again, we have to have the production budget ready to go before we can do the materials budget. But it's similar in nature to the production budget. It has the same beginning and ending inventories to worry about. The main difference from the production budget, one could argue this materials budget is a little bit more complex because it has a few additional lines to it. First of all, one unit of production may need multiple units of particular materials, and for that matter, you might have 3, 4, 5 different types of materials going into those units. So now all of a sudden you have one production budget, you might have 5 materials budgets to support it, however many materials go into that production. So there are different types of materials, but there are also different quantities of materials. Even though we're producing 1 unit of a product, it might require 3 pounds of a raw material. So there's one more thing we need to multiply by, and there's yet another thing we need to multiply by to get a price. The price per pound, price per foot, whatever our material is. Again, we need to know the company's policies on inventory maintenance, just like the production budget. They have a desired ending inventory to have enough materials on hand so that at the beginning of next month, we can start our production right away without having to wait for materials. Now for this one, it's generally going to be a percentage of next period's expected production needs. Don't go back to using sales units times a percentage for the materials budget. It's the production needs, which, remember, that's after we've already handled the beginning and ending inventories. So keep that in mind. Again, we already have some materials on hand. Last month's ending inventory became this month's beginning inventory. So let's see how this looks. Now, again, we are doing June, so we needed to bring over July's production needs, which we already calculated at the end. Well, let's go back actually for a second. Here's the production budget, the budgeted production. This is what we are producing. These are the production needs, the bottom line to the production budget. So that was what we needed there. Let's go see it again. This 16,000 units budgeted production for July, that becomes the 16,000 units budgeted units to produce for July. And of course, we bring over April, May, and June, 10,400 all the way through 19,800. As you can see here, it's at the bottom of the budget. We're not using any of these other numbers. It's the bottom numbers of the budget. Now again, we're going to have to multiply it by the number of pounds or yards or feet we need of that material. In this case, it's 7.5 pounds of whatever material we're talking about for this unit. So now we have it converted to a materials number. How many materials do we need for the current production? We're going to add in a desired ending inventory, which, as you can see here, it's 20% of next period's production needs for materials. So basically, it's the line right above it. Materials needed for current production, 20% of next month's. So for April, it's 20% of May's 139,500. For May, it's 29,700, which is 20% of June's 148,500. And again, for June, it's 24,000, which is 20% of July's production needs. That's where that comes into play. So we added in the ending inventory. Now we know the materials we need. But again, we already have some, so we subtract out beginning inventory. That tells us the materials we need to purchase to get them. And now we have one more thing to multiply that by. That's the price per pound, $2.50 per pound in this case. Now we've converted it to a cost of materials, but we also know a pound quantity of materials as well. So I will say the purchases and materials budgets, they tend to be two of the more complicated budgets because of the fact that we have beginning and ending inventories. We need to know how things carry over. So that takes us to the end of part one of this. With part two, we're going to be covering the cash budget, the selling general administrative, the labor, the overhead, all the remaining budgets. So I will see you in the next budget here.